Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
So this is probably the typical herd mentality overreaction to the reality that perhaps when the Fed is finally going to start to lower, which obviously is looking out at September, if not sooner, if there's some major crisis, is too late. And so now the question is what happens from here?
Do I think we are in a recession right now? No. Do I think that the increases in the unemployment rate and the softening in the labor market is worrisome and we could end up in a recession in, say, 3 months, 6 months? Yes, I am very concerned about that.
We're taking the steps for a more sustainably, financially effective Intel for the future. This is the biggest restructuring of Intel, I'd say, since the memory microprocessor decision 4 decades ago. We laid out the new operating model and we're taking decisive steps to execute on the process and product work that we've done to now combine it with an operating model to make us effective for the long term.
All right, we got 1 hour to go until the market closes, and we are seeing a steep sell-off for the major averages here. Looks like we are set for the worst reaction to a jobs report in about 2 years, Josh. So we've got the Dow right now down 754 points, and we haven't really come off the lows. I mean, a little bit, but not really. So down 1.9%. The S&P off 2.1%. The Nasdaq down 2.5%. And I got to zero in on the Nasdaq 100 for a minute here, because what we're seeing here from the Nasdaq 100 is since the highs of the year, that's a now more than 10% drop, which means the Nasdaq 100 has seen a correction.
Yeah, it seems like at this point, Julie, just a lot of investors have new questions about the economy, where it is and where it's headed. There was such a kind of common narrative that Jay Powell and the Fed had stuck the soft landing, as kind of rare and unusual as that is. And now I think you had the weak jobs report, but it wasn't just that data point. We talked this week about unemployment claims, we talked about manufacturing activity, and now I think just more investors thinking, they thought it was just cooling, but now worried about whether we're actually going to trip up into a downturn.
Yeah, a much more emphatic reaction to the data today, coming on the heels of what we saw for the rest of the week. Couple other things to check on here. The VIX here seeing a big spike up. At one point today, I do believe it hit 30 earlier in the session. Now it's hovering around 26 rather, but we haven't seen this kind of a level in the VIX in a while. Again, reflecting some of that concern. And then also you got to check on bond yields here. This big slide that you're seeing in the bond yield here, 3.8%, reflecting that perception that we're definitely going to get a rate cut in September. It could even be a half-point cut instead of just a quarter-point cut.
A lot of commentary about that.
Yes.
Today you saw from economists and strategists, has the Fed been behind the curve?
Right.
What can they should do next? And to your point, now moving from, are they going to do 25 or maybe 50?
Yeah, well, we're going to be talking about that all show long, asking a lot of people about that. But for more on the moves today and that we have been seeing this week, let's get over to Yahoo Finance's Jared Blickery. Jared?
Yes, what a whirlwind week. We also had a Fed meeting, if you remember. That was only a couple days ago. Let's take a look at what has happened this week. I'm going to put a 5-day on the Dow, and you can see things really, and Wednesday wasn't a bad day by the day, but things quickly soured in the middle of the day, and it's been heading down for the better part of the back half of this week since midday Wednesday. And you see that in the Dow down 2.5%, Nasdaq down even more, 3.5%. Remember the Russell 2000? Which was just really perking up, getting people excited that might actually have a chance of getting new highs because it hasn't in several years. Well, that has suffered the worst. That is down almost 7% this week. So just kind of dashing some hopes there. Here's the 3-year chart. It had recently broken out of this resistance level, and now it has come back, and arguably it's testing the breakout level. But looking at it goes down a little bit farther. I think people are going to be seeing that casting a trying to find my words here, trying to cast a glance at it. Now, here's a VIX. VIX is at the highest level that we've seen since 2022. You remember that we had a big bear market that year. Now, we're not quite up to the levels that we saw around the pandemic or even the global financial crisis. You can see that big spike up here. But this is concerning. You start seeing the VIX perk up like this and trending higher with higher highs. That just points to the fact that we're probably heading into a period of more serious corrections here. I just want to show you the sector action real quickly. Only staples in the green. Here we have consumer discretionary down 4%, tech down 3%. But check out the 5-day here. It's been just kind of a disaster for tech, down almost 6%. Are seeing some strength in the interest rate sensitive portions of the market. That would be utilities and real estate. Guys.
Thank you, Jared. U.S. stocks selling off after a weaker than expected jobs report for July. The signs of a cooling labor market stoking fears the Fed has waited too long to lower interest rates and renewing concerns about a recession now on the horizon. Joining us now to discuss all this is Jason Draho, UBS Global Wealth Management Head of Asset Allocation Americas. Jason, it's good to see you. So let's dig right into this sell-off, Jason. It's clear more investors have some questions now about this U.S. economy, Jason, just where it is and where it's going. What are your thoughts?
Well, if we just take the totality of the data, but looking particularly today with the labor market report, the way we would interpret it is the data has been consistent with the idea that we've had that the economy is going to slow this year from an elevated pace last year, and that's consistent. It is the labor market is going to cool and sufficient so that the Fed could start cutting rates in September. But I wouldn't interpret the data we got today or this week as really dramatically altering the odds of a recession. We still think it's a soft landing. We still think the recession risk is unlikely. And the reason I'd say that is if you look at just the overall state of the household and the consumer, we saw it actually tick up in March. The overall kind of health of the consumer is in good shape. That is the most important part of the economy. And in the labor market, certainly the job growth has moderated, but what you haven't really seen is any real uptick in initial claims. Yes, they've risen a little bit recently, but if you look over the past 2 years, they're pretty flat. In past periods, when you saw the labor market weak and you saw the unemployment rate rise, you'd also see a kind of a corresponding increase in the initial jobless claims. That has not happened. So what it looks like is that we're seeing a moderation of job hiring, but also not a lot of layoffs, and the labor supply in the past year has increased. And that's why the unemployment rate has gone up. So it's kind of giving a bit of a false, say positive in terms of how much the labor market's weakened. And so we sort of remain confident in the overall trajectory of the economy right now.
So, Jason, given that view, then, I wouldn't call today a market panic necessarily, but maybe a market alarm, right? An alarm being expressed by some economists and strategists. Do you think that market reaction is unjustified, and does that then open up opportunities for those who have a view similar to yours?
So I think the way we'd view it is if the S&P is down 6% roughly from its all-time high just a few weeks ago on July 16th. So the risk reward in our view is, it's at least for the S&P, is it improved. The tech sector is down about 12% of that time. We like the tech sector, so I think the risk reward again there has improved. In the very near term, though, it's likely that the market's going to certainly remain choppy, volatile, and given investor concerns about the Fed now maybe being behind the curve, that growth is slowing. If that gets any worse, if those kind of concerns rise, I think there's more risk to some downside. But I kind of think this is a little bit of a replay with a twist to what happened late last summer, last fall. The S&P fell 10% on the concerns that the economy was too hot and the Fed would actually have to make things more restrictive. Ultimately, that proved not to be the case and the markets rallied. I think this is a bit of a kind of a growth scare that's unwarranted to some extent, at least in terms of recession risk. And at levels of maybe we're down 10%, that's when you start to get investors want to come in and kind of buy. So I think we're selectively looking at opportunities, but I think that in the near term, the next few weeks, next month or so, it might just continue to be kind of sideways choppy in this range before the kind of a real turn happens, potentially with the Fed actually starting to cut rates in September.
Yeah, I want to pick up on that, Jason, because I'm interested in what you think the Fed's next move is in September, because there were plenty of economists and strategists today, Jason, who were I think they were looking at the data and say, Jay Powell may not do 25, he could do 50 in September. What do you think?
So we changed our view. We were at 50 basis points of cuts this year, 25 in September, 25 in December. Now we're saying 100 total, beginning with 50 in September. And the rationales, even relative to 2 days ago, when from the FOMC statement, from the press conference, Powell had alluded to that they will watch very closely the labor market data. This is further data since just in the past 2 days that suggest a cooling of the labor market. We're also sort of making a bit of an assumption, almost kind of going back to what happened 2 years ago when it was the Fed was accused of being behind the curve. They did a couple 25s, and then very quickly they ramped up to 50 and 75 basis point, rate increases to fight inflation. If you think the economy is slowing and inflation is going to come down enough, and you think policy is restrictive, it's not clear why you need to kind of go very gradual. If you want to get back to something closer to a neutral policy rate, say 4% or less, you should probably start with a bit of a bigger bang. You move with 25 basis points to curtail the risk that maybe the recession risk is rising. So that's the justification for why we think they would go 25. But again, our soft landing kind of view is not conditional on the Fed now doing 100. We still think the economy okay. If anything, that's a net positive in my view for kind of risk assets overall if the Fed acts sort of aggressively and sort of offers insurance to the market.
Jason, it's really interesting that you say that, because I would think if they cut a half point, that'll spook the market, right? That they'll take the interpretation not as the normalizing that you're talking about, but rather it's a dramatic move that, you've got some strategists out there, economists out there saying, floating the possibility of doing an emergency cut even before that meeting.
Where I would sort of differ on that view is that ultimately we don't think the data is going to slow enough between now and then, like now and mid-September. If it turns out the data continues to deteriorate quickly, then it might be the case that you're kind of past the point of inflection point where the Fed really is too late. So doing 50 is a signaling that they were concerned and it's already not enough. If the data continues to kind of hold up, like if we get a jobs print for August that is aligned with this month, I think that sort of validates the view of 50 basis points. But it's also not a sign that the economy to me is about to kind of tip over. And now that the Fed is starting to cut in line with the market's pricing, I think that would actually be a relief to the market that it's, the adage of the investors stop panicking when the policymakers start panicking, and a 50 basis point cut, I think would be interpreted more in that vein versus a negative signal. They know something that we don't know about the direction of the economy.
All right, good stuff, Jason. Thank you so much. Appreciate it.
You're welcome.
We're just getting started here on Market Domination. Coming up, Intel shares are plummeting and the Nasdaq 100 sliding into a correction. We'll recap the week in the sector and tell you about one stock that could be benefiting from Intel's lows. Plus, oil giants ExxonMobil and Chevron are also down today after both reported second quarter results before the bell. We'll get analyst reaction coming up. Stay tuned, much more Market Domination still to come. Let's get to call of the day here. A new note from Melius Research saying Intel's woes may be great news for AMD. And AMD, it's only up 0.6%, but on a day when we are seeing such a sell-off in tech, that is indeed notable. And this coming from Ben Wrights, he's over there. The note is actually on Intel. It's actually a downgrade for Intel,
right.
But he does mention this read-through for AMD in the note, which is interesting here.
Yeah, on Intel, they do cut to hold. They tell their clients here, when you don't generate cash and gross margins aren't stable, it's tough to call a bottom. They go on to say the second half was Intel's chance and they missed it. And then on AMD, to your point, is interesting. They talk about, listen, we've seen acceleration in share gains of late at AMD and heard about issues with Intel products. These things are hard to stop, they say, once they get going.
Yeah, and he says, while Intel's seeing excess inventory at some of the traditional automakers, we don't think AMD, for example, has the same problem.
Yep. All right, get more on this. We're wrapping up a big week in big tech, but the big move we're watching today, Intel, that stock is cratering after reporting disappointing second quarter earnings results yesterday, and the chipmaker suspending its dividend, laying off 15,000 workers. Joining us now to talk about this, Ben Beharin, Creative Strategies CEO and Principal Analyst. Ben, always great to have you on the show. So we look at this Intel print, Ben, miss on Q2, guided Q3 lower, massive restructuring. You say Intel probably, in your opinion, Ben, the biggest news of the week?
I think so, yeah. And I think it's because this was a bit surprising, right? I don't think this was something that people saw coming. Obviously, there was a note earlier in the week that was reported that some layoffs were coming, which I do think sort of set us in a position to brace for some pretty harsh numbers. But honestly, I think people had thought the worst was behind Intel. I mean, I genuinely believe that was a conviction by a lot of investors. And I think all this has done is proven that that's not true. And, I know they've been asking investors to be patient for a while, right? And just buy into the broad vision of the company and the product and roadmap for foundry and product. And I think this has just come into that's just really going to take a lot longer than hoped. And now there's a real big focus, much more than I think before, on short-term execution and product competitiveness.
And why, in your opinion, Ben, why is Intel we knew about the long build out of the sort of long foundry plan. We knew that was going to take a while. I guess the real surprise, to your point, is that they're not as competitive as they should be at this point with the likes of an AMD and others. What's going on there? Why aren't they?
So I think there's two parts to this, right? One, Intel has obviously been focused on their 5 nodes and 4-year strategy, which again was their process technology and products built on their process technology. And that's just process technology catch up, right? And AMD has been on leading edge process with TSMC, which many people, consensus view would believe that is the best process out there to be manufacturing semiconductors on. And so the AMD has a process leadership, and while at the same time competing right there with product. That's what makes this next product from Intel super interesting, in my opinion, and one that I think there's going to be a lot of scrutiny on in terms of competitiveness with Lunar Lake, because that is the first product that Intel's making that's built 100% on Intel's TSMC. Now, Intel's packaging is putting that product together, but it's being made on TSMC wafers. And so this is the first time we'll actually see Intel's architecture on a one-to-one sort of competitive process with AMD, and we'll really get a look at how competitive those products are. So I think that's step one, but their ultimate goal is to also now have that architecture back onto their leading edge process, which the next one will be, I think, 14A in their nomenclature, and bring now product competitiveness back to process leadership at their foundry stage. And I think if all those things play out, very, very positive, right? That brings competitiveness back to their product portfolio, pricing leverage, as well as a dominant position to now increase their IDM strategy. But a lot's just got to go right. That's the thing, is that there's a lot of things that have to play in their favor, which is why, again, I come back to short-term management execution is key, and product leadership has to be identified in the market.
Ben, I want to switch gears here and talk about Apple, a company you also know so well, Ben. Just curious to get your take on that print. And also, Ben, just to see where you're at when it comes to kind of the argument we hear from the bulls, which is that, these AI-enabled features, Ben, they're going to really spark this very strong upgrade cycle for iPhone, and whether you buy that, Ben.
Yeah, I mean, I don't like the term super cycle, Josh. I think you and I have talked about this for a long time. I think really I would anticipate a stronger than normal cycle. So call it whatever we estimate typical refreshes would be without AI. I think it'll be a little bit stronger than that. I do think there'll be demand. I do think there's going to be enough interesting things around Apple Intelligence that get people to have interest in that, want to upgrade their devices. But I don't think we're going to pull forward that many more devices like we do if we want to call it a super cycle. But I think it'll drive a stronger than normal cycle. And I do think Apple will be the tip of the iceberg for that. I think that'll impact positively for Qualcomm as well in the Android ecosystem. I think a lot of the AI on device stuff, again, coming to PCs too, which will help Intel and AMD as a part of that as well with Qualcomm. But I'm not going to call this a super cycle in any of those areas, but let's just say a stronger than normal seasonal cycle is possible.
Ben, I'm really interested to see how this sort of consumer AI cycle is going to go, or cycle or phenomenon or whatever it is, effect is going to be. On the flip side, when you look at enterprise, when you look at the companies that have told us what they're spending to build out AI this earnings season, and investors have not really rewarded them, with the exception of Meta. And then today, there was a write-up on a Morgan Stanley note on Microsoft that highlighted a pharmaceutical company that had pulled back on its AI spending on Microsoft products, I think specifically Copilot, because it didn't see the productivity gains that it wanted to. And I just wonder how widespread that kind of pullback is going to be. How much fits and starts is this whole AI rollout going to be?
Yeah, I think honestly at the software level, you're absolutely right. We're going to hear more of these stories, and it's going to be rocky. We are really in a laying of, digging the canals for rivers, laying the streets for cities, laying the fiber right in the ground for telcos. Like, that's where we're at. We're in infrastructure stage. While that's still continuing to develop, and we're seeing continuous development in terms of size of models, innovation in compute, the need for more compute, it's just really hard. And in my opinion, sometimes a little bit too early to kind of estimate what that's going to go from a software standpoint, because when you're early in a cycle, those lessons that you learn might not actually be the lessons that you learn over the long haul when you're making those software investments. So I think the software side is going to take time. We hear similar conversations from CIOs. We do our own CTO surveys. We see where their project spend is right now, what they're looking for in terms of productivity increase on top of that ROI for employees. There's still optimism. There are promising signs, but nobody is moving into full deployment yet. And until that happens, and I don't expect that to be mid to late of next year, if not into 2026, we're really not going to see this software cycle start to kick up, because we really need to get through this infrastructure cycle, which is being led by semiconductors, before we can transition into that software build out stage.
I'm curious, Ben, we've heard from all three cloud giants now, Alphabet, Amazon, Microsoft. What do we learn during this earnings season just about the general state of the great cloud wars right now?
Yeah, I mean, all of them continuing to go big on CapEx. It feels like they all believe that the more they spend in CapEx, the more they double down on that infrastructure, which I do think is interesting. All three of those names that you mentioned highlight their custom silicon, their custom ARM-based silicon, as well as part of that moat and investment in that CapEx. And so they're trying to spend and build out and create those moats with CapEx. And I don't see that changing. That continues to be a great story for all semiconductor infrastructure, networking, all of that. I think the challenge is still tying that to the software story. And that's why I still sort of come back to like this, the macro story for the data center refresh, the AI server build out for hyperscalers and even tier 2, tier 3 cloud companies on the back of the silicon infrastructure remains intact. The software questions still are going to be ones that we're going to wrestle with now still for another 12 months, if not longer, but we're still building out that infrastructure. So it's a good time to still be looking at infrastructure stocks, because I believe that macro thesis remains intact.
Building the canals, laying the streets. Ben Verhaeren, thank you very much. Appreciate it.
My pleasure. Anytime.
Let's check in now on some of the other day's trending tickers here. Cloudflare catching my eye today because this is another one that's bucking the downtrend, jumping after raising its full year outlook. That guidance soothing concerns of a business slowdown. So, you know, it's tough to find green on the screen today. AMD was one that we found. Cloudflare is another. It's a cybersecurity company here, and indeed the company did raise its forecast. One analyst over at RBC calling the quarter impressive because, especially given the macro backdrop that we're seeing right now, and also that it is benefiting from Gen AI, which I also thought was interesting.
Yeah, raises its full year revenue and earnings outlook. There at RBC was Matt Hedberg there, and what he did call an impressive quarter, particularly called out there in an uneven macro. And that was an interesting note, Julie, I thought, because he says, listen, the company doesn't break out contribution from Gen AI related revenue, but he told his clients he'd put it in the bucket as one of those companies, one of the few software companies seeing what he would describe as tangible benefit joining the likes. He said Microsoft and ServiceNow rates this one outperform, and Matt's target is 99.
The stock is down year to date, though, which is kind of interesting. It's down about 5%, even with that increase today. So we'll see how if it sort of picks up some more steam.
Moving on, taking a look here at Shopify and Palantir. Now, those shares unable to escape the beatdown in tech today as the broader market, of course, fallen sharply on that weaker than expected jobs report. Both companies gearing up to report their quarterly results next week. Palantir is interesting. The team at Jefferies out with a preview. They said, listen, this stock is, in their words, priced for perfection. Maybe a little less after today's move, but can continue, they said, to trade on AI enthusiasm. And it was Brent Till, we know Brent very well, said it is the most expensive name in his coverage universe. Wow. However, he said Palantir has had back-to-back quarters of solid execution. Said they view the company as a rare blended AI apps and infrastructure asset with near-term revenue momentum. But he says, I think on that valuation, he's going to stay on the sidelines.
Yeah, and let's talk about Shopify real quick, too. Those shares down 30% year to date here. Analysts there looking for 20 cents a share in profit, revenue of just over $2 billion. And it's gotten actually a couple of positive analyst calls recently. KeyBank, back on July 24th, resumed coverage on the stock with an overweight and called it the leading e-commerce platform well-positioned to capitalize on e-commerce expansion into retail. And then Bank of America upgrading it even earlier in the month to buy from neutral, saying following years of declining margin, we believe that the company has turned a corner on balanced growth and margin. So we'll see here after the slump that we've seen in Shopify this year, if it can recover. But it is interesting to see both Shopify and Palantir, so very different companies, obviously, just both tech. That's just the thing that sort of unites them. But getting caught up in this today as we await the numbers next week.
Sell. Shopify, I mean, in the red this year over the last 12 months as well. But most on the street, to your point, they do like it. Yeah,
we'll see what happens. All right, and one more stock that we're watching, MercadoLibre. Those shares rising after exceeding Wall Street's expectations in the second quarter. The company delivered a beat on the top and bottom line. Gross merchandise value jumping by 20%. This is such an interesting company because they're a big e-commerce company, but they're a big payments company as well in Latin and South America here. Not only did it see that GMV number go up a lot, profit doubled, and it had a record number of users on its fintech platform. It has just been expanding very aggressively into new markets.
Yeah, you could see the reaction from investors today, and for good reason. There's not much to pick at here. I mean, Q2 earnings beat, profit doubled, record number of users for that fintech platform, net revenue $5.1 billion, that beat. Net income, it looks like $531 million, also a beat. GMV jumping 20%. Core business here, e-commerce, electronic payments, but we know they've also been moving into advertising, insurance, other verticals as well.
Yeah, and one other thing that caught my eye here is that its market cap now is at about $89 billion. If it gets much higher, it could surpass Petrobras, the Brazilian state-owned oil giant, in terms of market cap, which would be pretty remarkable.
Yeah, keep watching.
So we'll keep watching on that one. All right, it is about a half hour till the closing bell, so let's check in on the markets and take a reading on the sell-off that we're seeing today. The Dow, again, up off the lows of the session, but still, the sell-off is steep here, down nearly 700 points, 1.7%. The S&P down 2%, and the Nasdaq down by 2.5% as well. As I say, it's pretty broad. We've got small caps selling off as well, and all of the groups in the S&P 500 have been feeling the pain today, with the exception, a little bit of gain here for consumer staples.
Which is, so people may get a little defensive. I mean, look at even small caps not working today's trade.
Nope.
Coming up, the expectation is for the Fed to cut rates at their September meeting, but could they go as far as cutting by half a point? We're going to discuss when market domination returns. The focus on the Fed is not just about whether the central bank will cut in September, but by how much. New notes from JP Morgan and Citigroup today now forecasting the first rate cut of the year to be 50 bips. Both notes citing a weak July jobs report. And earlier this hour, we heard from Jason Draho and UBS Global Wealth Management, who also alluded to the softness for changing his expectations.
So we changed our view. We were at 50 basis points of cuts this year, 25 in September, 25 in December. Now we're saying 100 total, beginning with 50 in September. And the rationales, even relative to just 2 days ago, when from the FOMC statement, from the press conference, Powell had alluded to that they will watch very closely the labor market data. This is further data since just in the past 2 days that suggest a cooling of the labor market.
So on Wednesday, Julie, at that presser, it is true, a reporter, remember, did ask Jay Powell, is a 50 basis point cut as a first cut at all likely or even on the table? And Powell said, well, that's not something we're thinking about right now. But then did go on to say also something that looks like a more significant downturn would be something that we would have the intention of responding to.
I love it when Jay Powell answers a question and he answers it and then he thinks a little bit. Because when the reporter first asked that, he said no. He just said no. And then he kind of gave a little more context for it. But his initial sort of gut reaction was, no, we're not thinking about that. But then you get a number like this, and as JP Morgan's Mike Feroli put it, he said the Fed is at least 100 basis points offsides, probably more. And he even brought up the idea that maybe, he said, from a risk management perspective, we think there's a strong case to act before September 18th. In other words, an intermeeting cut, which would be like blaring alarm bells to the market, right? That something is really wrong in the economy. So it's interesting that he brought that up. Remember, as we talked about the other day, we still have the Jackson Hole meeting at the end of August. So that's plenty of time for Jay Powell to sort of manage the market's expectations.
And before September, of course, Jay Powell also has a few more important reports to look through as well.
Exactly. Yes. Good point. All right. Well, for more on the path ahead and for what a rate cut or rate cuts would mean for investors moving forward, let's welcome in Ross Mayfield, Baird investment strategist. Hey, Ross. So, busy day that we've got going on here today. Do you think we're going to see a half-point cut in September? And, what are you hearing from clients? What are you hearing from colleagues in terms of the alarm and the change in sentiment that we're seeing today?
Yeah, it's a great question. I do think a 50 basis point rate cut should be on the table. I think the Fed will consider it. I think with hindsight, it's clear they probably should have started cutting in July. And if you just view a 50 basis point cut in September as a July and September cut, I think you can get there mentally. I think they'll probably avoid that intra-meeting cut just because of what you said. It will set off alarm bells and maybe look more panicky than they actually feel they need to be. I mean, look, it's a weakening job market, but some of the action today in the equity market is acting like recession is on our doorstep. And I don't think so. We still have a broadly pretty strong economy, cooling, certainly, constrained by rates, certainly, time to start cutting for sure. But we're not on the doorstep of recession, despite the SOM roll, and the yield curve. So I think that 50 basis points in September and then some really aggressive forward guidance for what they're looking at will be enough to placate markets. The problem is you've got a long lag time until that September meeting.
So you mentioned, Ross, the SOM rule, the yield curve. I'm just interested, what other data points, what other metrics are you watching very closely as you try to gauge here whether the economy is just cooling or no, it's really going to trip into a downturn?
Well, look, this cycle has been all about traditional indicators not working as well as they have, right? The yield curve, the LEI, so the SOM rule is obviously historically very powerful, but I think we should pause guarantee of recession kind of status. The bigger problem is that the package of labor market data has suggested weakness. JOLTS, PMIs, initial claims, the non-farm payrolls. We've seen unemployment tick up month after month. And the Fed has largely ignored those warnings. Now we find ourselves here where you've got a clear weakening of the labor market. So I think the thing you have to do is take the full package of data and say, all right, we have a cooling economy. It's clearly normalized post-pandemic. Now the question is, does it continue to weaken from here? I think you have to, at this cycle, post-pandemic, all the idiosyncrasies, take the biggest possible swath of data into consideration and not just rely on one or two indicators that's worked in past cycles.
Well, and not just the macro indicators, but what we've been hearing from companies, right? We're in the midst of earnings season. We've had a lot of our commentary here. And some of it has indicated, for example, that there's slowing consumer spending. So how are you sort of reading those reports into this whole narrative?
Yeah, the consumer is tricky. I mean, obviously, there's a growing dispersion in how the individual consumer companies are doing, how the market is reacting to their reports. I think the thing that's really important to remember about the consumer is, we talk about it in aggregate, but the consumer is as bifurcated as it's been in a long time. You have the lower income consumer who is really struggling with inflation, food prices, rents, hasn't seen, wage growth and isn't benefiting from a higher stock market and appreciating home prices. On the other end, you have higher net worth consumers who are benefiting from all of that, who probably are more likely to own their home, have locked in mortgage rates at a low percent, and have a lot more cash than they might have otherwise. So there's this consumer bifurcation that I think you're starting to see play out in the companies. So quick service restaurants have struggled. It's not like high-end consumer companies have been immune to this slowdown, but I think it's worth noting that the consumer is not a monolith, and there's different pockets that have different trends going on.
So Ross, add it up for us. Given kind of your general outlook there on the economy, the Fed, the consumer, how do you want to be positioned in the equity market right now?
To be honest with you, I think the sell-off probably has a little more room to go. I think there are some technical factors at play. Sentiment is clearly flipped. A rising VIX will trigger some sell signals, and I think there could be a little bit more selling in the near term. But personally, I would lean in. One, we know that sell-offs happen. The average intra-year drawdown in the market is something like 14%. So this is kind of just table stakes, right? You still have a pretty strong technical backdrop. You have falling yields. You have a Fed who I think is going to get on board. And the economy, while slowing, is still pretty strong, right? A couple of days ago, we were talking about a pretty healthy economy. One manufacturing PMI report is not enough for me to get spooked. So I would want to focus on high quality companies, especially for a higher for longer rate environment. But I would be leaning into this sell-off, to be honest with you. I think there's still more for the bull market to go before it finally ends.
Specifically in tech, Ross?
I think that the adoption of AI, this whole cycle is going to be choppy. There's going to be air pockets along the way. But in this kind of environment, I think you want to be levered to secular growth themes. AI is very clearly that. I think you use weakness in the tech names and the growth names to add, especially the players who can consolidate, share in downturns and in weaker periods. But I think in an economy that at a highest of high levels is still a slower growth developed economy, you need to be levered to secular growth themes. AI is that, so I would be adding to tech.
What did you make, though, Ross? I did think an interesting theme that kind of developed this earnings season, I'm really curious to get your take on it, was it did seem like investors were, pushing back, maybe a little skeptical than I remember of that mega AI trend. They were sort of saying, okay, spend, but where is the ROI? I'm just curious what you made of that kind of creeping skepticism.
Yeah, one of the sayings that I've returned to a lot and I think is really powerful for AI is, we tend to overestimate its impact in the near term and underestimate its impact in the long term of other big technological changes, right? I think that right now consumers are rightfully saying, hey, you're spending all this money. Where is the killer application on the other end? How does AI improve productivity at the utility company down the street or the consumer staples company in my portfolio? I think all of that will come. I think there are real productivity enhancements to be had across the spectrum of industry and sector, but it might take longer than investors are comfortable with. And especially when you see these CapEx numbers quarter after quarter after quarter, not immediately turn into earnings and market share and profitability. So I think it'll be choppy, but these are the types of themes we want to be levered to when we look 5-10 years down the line. And I think those killer applications that people want to see will be there. It'll just take time, same as it did for the internet, same as it did for the smartphone, and maybe longer than investors, in the near term have comfort for.
Ross, great to see you today. Thank you for joining us, and have a great weekend.
You do the same. Thanks.
Shares of oil giants ExxonMobil and Chevron under some pressure today after both reported second quarter results before the bell. Chevron's adjusted earnings per share falling short of expectations, while Exxon beating across the top and the bottom lines. Joining us now is Stuart Glickman, CFRA Research Energy Equity Analyst and Deputy Research Director. Stuart, it's great to see you. So let's dig into some of these names, Stuart. So Chevron, adjusted EPS for Q2 misses. Cash flow from operations, 6.3. Stuart, Street was closer to 8.9. Curious to get your just initial reactions on that print. What did you make of the report?
Yeah, I thought the print today for Chevron was pretty underwhelming, disappointing. You have an expectation of close to $3 in earnings, and you come up with 255. And a lot of the weakness, I would say, is attributable to international upstream. For Chevron, they had some operational issues in Kazakhstan, which weighed on them. And then on top of the print, now you've got the problem of prolonged uncertainty related to the Hess transaction, which now it looks like the arbitration is not going to happen until May. Perhaps a decision, I would guess, late 2025. So investors really have to put up with a lot of headwinds to buy into the Chevron story. We've kind of thrown in the towel here. We downgraded Chevron today to a hold from a buy, and our new target price is 162, which is up marginally from where we are today, but not meaningfully.
Stuart, do you see any reason to buy this stock before that deal if and before that deal closes?
So, Julie, great question. So I think the issue with Chevron is you have to presume that a scenario analysis where Exxon prevails in arbitration, right? And Chevron has already said they will walk away from the Hess deal if they don't get the crown jewel, which is Guyana. So in that world, Chevron is, arguably a little more gas focused than Exxon is. Certainly it has growth potential from Kazakhstan. They have the concession until 2033, possible to extend beyond that. And they have a yield of somewhere between 4 and 5%, which is reasonably attractive. But to be fair, a lot of their other growth opportunities, for example, Deepwater Gulf of Mexico, those probably draw a lot more interest from investors if oil's back around $80, $90, and we seem to be slipping, and I think that too is weighing on Chevron a little bit today.
And then another one on Chevron too. Amidst all of this, the company says, "Oh, we're going to relocate to Texas from California." Is this right. While all this is going on, right? While they're under these pressures, while they're trying to figure out this deal, is that the right time for them to be undergoing this type of a move?
Probably not. They've been hinting at problems with California and telling folks, look, this is not the easiest place to do business, particularly for refining with the environmental restrictions that California places on refiners in the region. It was argued that this is about, their customers are located in Houston, but customers have been in Houston for a very long time. I think it has a lot more to do with politics. And so, to your point, it's a bit of a high wire act to pull off a successful move of the headquarters to Houston while you also have all these other balls in the air. It's not the best timing.
And Stuart, get your thoughts on Exxon too. So their reports, they exceed profit expectations. The Pioneer acquisition also there, Stuart. I know it's early days, but how do the synergies look there to you?
Yeah, in contrast to Chevron, Exxon really has the wind at its backs right now. The Pioneer transaction put a lot of incremental oil into Exxon's coffers this quarter. Then you have, of course, their 45% stake in Guyana, which they already own, which is throwing off considerable incremental oil, not just this year, but probably first oil from other developments in the block in 25, 26, and 27. Those are all likely to come to the fore. So Exxon's got, in my opinion, a much better story to tell. And we retained our buy opinion, or 4 stars opinion on Exxon, and raised our target price to 135.
I'm curious, Stuart, for Exxon, what you think the biggest risk is.
I think the biggest risk for Exxon probably is really industry specific. Certainly they're about as well provisioned as one can be on a balance sheet. Net debt to cap is around 6% or thereabouts. But when oil prices suffer, everybody takes it on the chin, including Exxon. So I think that because a lot of the value that's being created is driven by upstream, your biggest risk is that oil goes south of $60 and everybody starts worrying about, is the dividend going to be preservable, things like that.
Gotcha. All right, Stuart, thank you so much for your perspective and analysis. Appreciate it.
Thank you.
Coming up, a steep sell-off hitting the major averages, but there's one sector that's not doing quite as badly, and that is utilities. It's avoiding most of the damage. We're going to take a closer look at that sector next on Market Domination. A tough day for the markets, but not all sectors are being hit equally here. Utilities are down on the day, but it's one of the better performers in the broader markets as labor weakness and earnings weigh on the major averages. Utilities have managed to defy a string of weak sessions for the broad market. The sector is now the best performer in the S&P 500 so far this year. Joining us now is Brett Kenwell, eToro U.S. investment and options analyst. Brett, thanks for being here. This one definitely has caught our eye a lot this year, right? Because it's one of these groups that can benefit when rates are going down, and then there's the whole data center or AI thesis here. What do you make of what we've been seeing from utilities?
Yeah, I think when we look at utilities, we see a sort of collection of catalysts playing out for once. Usually this group is just looked at purely as a flight to safety group, a group of stocks that investors can go to for stable cash flows, for slow but steady revenue growth. And when we, get to periods where volatility spikes, kind of like what we're seeing right now, we do sort of tend to see that, that flow into utilities where people are trying to hide out and protect themselves from some of that volatility. But, I think when we look at the group now, there's actually a collection of other catalysts at play. You mentioned the AI theme helping drive some of these names, and I think that's a great story talking point. But when you look at some of the more hard data, the hard numbers, they pan out well for the group too. Specifically, earnings growth is expected to be, for 2024, annual earnings growth is expected to be the best year of growth since 2009, coming in at 10.8%. And that's not coming off of a bad year the year before. In 2023, earnings grew almost 9% for this group. So we're looking at pretty solid earnings growth. And, earnings growth without an attractive valuation, you could argue it doesn't matter. But in this case, that valuation actually is pretty attractive. Coming into, we've had a pretty big rally over the last month, which doesn't help the valuation argument. But, we came into July looking at 15 to 16 times forward earnings, which is not only cheap compared to the S&P, but on a relative basis, it's also pretty cheap. This group tends to trade at about 18 times forward earnings. So when you look at those, the earnings and the valuation, now the Fed is on, it's expected to cut rates, in September. That's another catalyst. So I think a lot of things are kind of lining up for utilities.
Another defensive sector traditionally would be healthcare. Brett, I'm just curious to get your thoughts there.
Healthcare is another great looking group. A lot of the individual names here have been trading really well, whether you look, at AbbVie, Thermo Fisher, Johnson & Johnson's been coming back lately. So, I think when you look at healthcare, they've been kind of middle of the pack as it relates to when you look at the year-to-date returns for S&P sectors. But overall, this group continues to trade well, and kind of like utilities over the last few days, probably a little bit of a flight to quality. Investors looking for, secular growth, a little bit more defensive positioning. But overall, this group continues to trade pretty well. I think, you look at Eli Lilly, that's kind of the all-star of healthcare. Well, at one point, it was knocking on the door of $1 trillion valuation. So I'd be curious to see how that name starts to hold up here in the next couple days and weeks. Just as it's pulled back about 20%. So seeing how investors react to that type of rotation we've seen out of some of the bigger names, very curious to see how that goes.
You speak about rotation. It's funny because we've talked a lot about rotation recently. Most of it's focused sort of on the small caps, but these other groups that you're talking about definitely have been beneficiaries. Utilities, healthcare, consumer staples, for example, which are also outperforming today. What kind of options activity have we seen in the markets to support these moves? In other words, does it seem like people think this is going to last?
That's a really good question. And it's really interesting when you start to look at the options market and the market in general, and you start to look at different timeframes. And, can we keep going down in the short term and can we continue to see this rotation, specifically this rotation out of mega cap tech and large cap names and the flow into small and mid cap names? And yes, we can continue to see that type of rotation. But, the sort of the catalyst behind the small cap trade, which it's been due to play catch up, right? But we've kind of seen that take a little bit of a hit these last few days as investors worry about, the bigger picture, the economy, the macro risks. And, we're sort of seeing some of that money come back out of small caps. I think small caps can continue to do well, provided that we see the economy hold up and provided that, some of these recession fears don't come to fruition. But overall, I don't expect necessarily that rotation out of mega cap to continue for all that long. When you look at these mega cap names, specifically, I mentioned Eli Lilly, but when you look at the Magnificent Seven, these are not only the most liquid and popular names, in the market, but they're also the best businesses in the market. They have robust cash flows, strong balance sheets, pretty steady earnings, great margins typically. So I think that at some point, investors are going to start circling back at these names. You see NVIDIA down 25%, Google and Microsoft down 13%. Amazon, I think, was knocking on the door of down 20% today. So at some point, investors are going to circle back to these names maybe later this year.
Brett, great to have you on the show today. Thanks so much. Appreciate it.
Yeah, thanks for having me.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned. Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day. As we mentioned, a little bit off the lows of the session, but still a drop of more than 1.5% for the Dow, down 613 points. The S&P 500 down 1.8%. It looks like the worst reaction to a jobs report in a couple of years here, and the Nasdaq down by nearly 2.5%. Selling also quite acute in the Russell 2000. So it's not as though investors are rotating into small caps today. Quite the opposite. They are getting out of them. And this is opposite the action we've seen recently, where we've seen yields come down and folks go into small caps. That's not happening today. You got a drop of 18 basis points to 3.79% in the 10-year, reflecting that view that, yes, the Fed is going to cut in September. It might even cut by a half point and then go from there. And yet we are not seeing really many areas of the market get a benefit from that. Taking a look at the VIX here, again, off the highs of the day, but still at 24. Let's go to Jared now for a closer look at today's action. Hey, Jared.
Hey, Julie, and it was a good payroll report, too. I mean, it wasn't a disaster by any stretch, but the reaction, very telling here. And I like that you kind of left off on the VIX. That is at the highest level since the 2022 bear market. So let's cycle through some heat maps here and just kind of assess the damage. Today, consumer discretionary was the biggest loser. That was down 3.67%. But tech and energy, both of those down by more than 2%. So were financials. So were industrials. So pretty broad swath swath of stocks, cyclical and growth, and a little value in there, all down 2% or more. Staples, utility, real estate, the three defensive sectors, I think that's telling. Those are the ones in the green. And let's cycle over to our leaders board for the day. Only some action in bond and low volatility saw green. Oil market, and by the way, oil was down, I think 3 or 4% today. It was down yesterday, and to have oil back-to-back down like that, when the Nasdaq is down back-to-back like that, I haven't seen that happen in quite some time, rather unusual. So I don't know if there's anything to read into there, but just kind of shows you the unusual market that we're dealing with. Got to take a look at semiconductors today. Really pretty bad look here, except NVIDIA and Broadcom, at least they're not dark red. Neither is AMD. AMD was actually positive for much of the day. That's more of an earnings story. But then you turn to software, looking pretty grim here. Lots of dark red. Salesforce, Oracle, Adobe down 3%. And then unprofitable tech looking even worse. So that's one of the changes. Julie was mentioning the Russell 2000 in weeks past was a benefit of that rotation. We saw that in ARC components, but not today and not yesterday. So kind of a shift in tone where it's risk off across the board. Josh?
All right, Jared. For more on a rough day and chaotic week for markets, joining us now is Michael Darda, Roth MKM Partners Chief Economist and Macro Strategist. Mike, always good to have you on the show. So you look at this July jobs report, Mike, and the recession signal you said intensifying. In fact, you said to your clients, Mike, a recession may already be underway.
That's right, Josh. Thanks for having me on. So we've seen a very persistent rise, not just the month of July that we received this morning, but a very persistent rise in the unemployment rate and the underemployment rate from the cyclical trough seen back in January and April of 2023. So we have the unemployment rate up 9/10, almost a full percentage point above the cyclical trough for the cycle. Year over year, we're up 8/10. Those two things have never been seen outside of recessions. And there's a different way to look at the unemployment rate called the Sham rule. So that looks at a 3-month average for the unemployment rate and compares it to the low point for the 3-month average during the preceding 12 months. Anytime you rise half a percentage point on that basis, the economy has tended to be in recession already, at least by a few months. And we were up 0.53 unrounded on the so-called Sham rule in July. So the thing to keep in mind here is, yes, payrolls are still positive. GDP growth has still been printing positive. But those variables tend to be pretty dramatically revised in a way that the unemployment rate is not. And so it's not uncommon to still see positive job and GDP growth in the early innings of recession. Many times that can be revised away. So perhaps that's what the market is sniffing out here. The September Fed meeting is still a ways away, more than a month away. So if the economy really is just now falling into recession, the Fed's going to end up way behind the curve for a bit here.
Mike, this is really interesting, and I think it's really interesting also because of what we have seen in terms of consumer sentiment, the so-called vibe session, when even things were growing, even though we were still seeing growth in employment, people didn't feel good, in part because the inflation rate kept going up. And I know that you're a numbers guy, but I am curious about your read on the vibe out there, because in some ways, when you have inflation inflecting to a better place, you would think that sentiment would be improving. Ironically, at the same time we're entering recession. How are you thinking about that?
Yeah, great question, Julie. So we have seen really depressed confidence levels, especially consumer expectations about the future. Even though those readings out of the conference board improved a little bit in July, they've been basically stuck at recessionary levels straight through this expansion. And a big part of that probably is a frustration with elevated prices, high inflation, and now even though inflation is decelerating, people don't really feel that. They just know they're paying 20, 25% more than they were a few years ago every time they go to the store. So that's certainly taken a hit on sentiment. It really depends on what's driving inflation lower. So if you have lower inflation because demand is weakening, the economy is losing steam, the labor market is starting to to roll over, then that's probably not going to lift consumer sentiment rather than just a supply side story, right? Which was at least part of the story last year for inflation coming down, where these adverse supply shocks were starting to reverse course. So you have a lot of moving variables here, and the Fed did, do a historic tightening of monetary policy, which was required after they fell behind the curve and inflation took off. So pretty unusual to get through a period like that with a soft landing that persists. I mean, we've essentially been in what looks like a soft landing. We've been calling it a late cycle environment with elevated recession risks. And, perhaps some just popped the champagne cork a little too early on the soft landing, because we've seen other cycles where it looks like, okay, growth is just accelerated. We're kind of moving around trend, and then, and then recession start. And it's really those unemployment rate metrics that I think are the best singular variables for business cycle peaks coming into play, whether it's the unemployment rate, or you can look at the U6 measure if you like. But I really think the best single variable is probably just the ordinary unemployment rate.
And Mike, I'm just curious too, if you saw the Fed cut by 50 bips in September, what would the effect on the American consumer be? Like, how would you map that out? What would be kind of the immediate ripple effects?
So a great question. It really is going to depend how far behind the curve they are. If they're not much behind the curve, then, you basically preserve most of the economic cycle, maybe just a mild downturn. The problem is, I think, the Fed skipped doing a rate cut this week. So to do 50 basis points right out of the gate, I think we're going to need to see a lot more pain in risk markets and a lot more weakness in macro data for them to get comfortable doing that. Because if you start off with 50, it's sort of an admission of error, right? And no one likes to admit that they were wrong, especially central bankers. So you're probably going to need a fair amount of additional macro weakness ahead of that meeting to get them to go by 50. And then the question is, is that even going to be enough? And I'll give you one example of that. If you look at the 5-year inflation expectations in the bond market, they've dropped almost 70 basis points since mid-April. So the Fed just holding the funds rate constant with inflation expectations dropping 70 basis points is equivalent to a 70 basis point rise in real rates. So even a 50 basis point cut would not completely reverse that. So my concern here is they're falling behind the curve. The business cycle is essentially ending, and we just don't know it yet because it's not completely obvious, and won't be until the recession has been going on for some time. And that means that the Fed will simply be late. So the first few cuts probably are not going to rescue the stock market or business cycle.
So Mike, finally, I want to ask you, where should people go? And you've been talking about going defensive, utilities, I know you've liked. Is that still the playbook as things maybe are worsening here?
I think for now, unless I read the screens wrong, it looked like the utilities were actually still up a little bit today, along with staples and maybe real estate. So we do have the defensive sectors doing what they should do, which is to act as a shock absorber when risk markets start to roll over. Unfortunately, the market cap just isn't big enough to really buoy the broad indices like the S&P 500. But I think for investors, what looks good here, we've been recommending the utilities since October of last year when the 10-year hit 5% briefly. So the utilities have done quite well. We think they could continue doing well. Healthcare is another sector that tends to not be super tied to the business cycle in the economy. It's underperformed, but the valuations look attractive in our view. So I would say stick with the defensives for now. If the recession really does play out and the S&P 500 does end up in a more meaningful correction or bear market, at some point it's going to be time to be looking at cyclical groups, but not necessarily the areas that have been leading the charge over the last 18 plus months. I would be thinking more along the lines of value and small cap, but it's probably too early yet. I mean, in the beginning of a downturn, the cyclical areas tend to take it on the chin. So I think we have to have a little bit more patience for some of the cyclical areas, and the defensive should be fine for now.
Gotcha. Well, utility is up, about 17% so far this year, and more than that since last October when you made that call. Thanks so much, Mike. It's great to see you.
Thank you.
Intel shares plunging by 26% today on its earnings and cost-cutting plans. But because of its already low share price compared to other Dow components, the decline did not have a major impact on the blue chips, a mere 37 points. And it's also raising the question of whether Intel should be included in the Dow at all, whether it should be kicked out. Joining us now, Barron's senior markets analysis writer, Paul LaMonica. Paul, it's great to see you. It was shocking to see that kind of a decline in a company the size of Intel and one with the sort of history that Intel has. So what does happen now in terms of its standing in the Dow?
Yeah, I think it's a bit of a wait and see, Julie. We know that the people who make the Dow, who construct this average, are very loath to make kind of knee-jerk reaction changes. So if you look at a company like Walgreens, for example, it had been struggling for a while before the Dow pulled the plug earlier this year, decided to replace it with Amazon. So I don't think this is a type of scenario where Intel is going to be removed in the near future, but it wouldn't surprise me if sometime maybe in 2025, there is a decision to be made, and Intel, because it has by far the lowest stock price in the Dow, it would seemingly be the stock that makes the most sense to get rid of, especially since there are a lot of other chip companies that are much more valuable right now and arguably better barometers of the semiconductor sector that they could put in instead to replace Intel.
Yeah, so that's where I was going to go, Paul. If Intel was removed, who do you think takes its place?
Yeah, it really depends, I think, if they wanted to do like a one-for-one switch and replace like with like. So if you do that, NVIDIA is obviously the number one contender, a company that has about a $2.6 trillion market valuation, was more than $3 trillion before this recent slide, obviously. The leader in AI chips. If AI today is what the internet was in the late 90s, then you could see for the foreseeable future, NVIDIA will be the major company in semiconductors. But there are other mega caps as well. You've got Qualcomm, Broadcom, and remember, NVIDIA and Broadcom very recently split their stocks. So they're now in that sweet spot. They're not $1,000 4-digit stocks that would that would have a huge weighting on the Dow and we wouldn't be allowed in. Now they could be because they split their stocks. And then finally, don't forget AMD. It would be ironic if AMD replaced Intel in the Dow, since AMD has been kind of, trying to play catch up to Intel for a long time. But you've got to give credit to Dr. Lisa Su and what AMD, that company, has done over the past couple of years. It's been nothing short but phenomenal.
And Paul, we always like to have the debate about how relevant the Dow even still is, because it is price weighted, because, just the composition of it is a bit different here. So, how should people, investors, retail investors in particular, be thinking about the Dow versus the S&P as they're trying to figure out the health of the market?
Yeah, I do agree that at the end of the day, the Dow probably gets more attention than it deserves because it's historic. It's been around a lot longer. It has those eye-popping numbers. I mean, it's the one that trades 30,000, 40,000, hitting those milestones that are much higher than the S&P 500 and the Nasdaq. And it's 30 very well-known companies to probably retail investors, but also consumers who may not necessarily be investors. They've heard of probably all 30 companies in the Dow. So, and it would be very psychological to get rid of Intel and replace them with another company. But yes, you are correct that changes to the Dow probably won't have that much impact on your investments because you don't have the tons of index funds and mutual funds where people are trying to beat the Dow. They're all benchmarked to the S&P for the most part.
Yeah, good point. Paul, good to see you. Thanks a lot. Appreciate it.
Thank you.
Stick around. We've got more market domination overtime coming up. Today's week, jobs data has led to increased talk of a recession, but is that narrative realistic? Joining us now with more, Yahoo Finance's Rick Newman, who of course is looking at not just whether the recession's happening, but how it's going to be viewed in the political realm. But let's get to the recession question itself first. You know, Rick, we just talked to Mike Darda a few minutes ago, and he said we could already be in one.
Well, we had another recession triggered with the jobs report, which is the SOM rule.
Yeah.
But I would like to remind people that we've had many recession predictors that have been triggered in the post-COVID era. Remember when the yield curve inverted? That was 2 years ago. It's still inverted, but we've had no recession. The leading economic indicators, that's supposed to tell you if a recession is coming when they are negative for an extended period of time. Also been negative, also no recession. And in 2022, we had 2 consecutive quarters of negative GDP growth, which some people think is a recession. Nope, that wasn't a recession either. So you're hearing people play it both ways. And of course, we've had a complete flip in the narrative in the stock market this week. But the consensus that I'm seeing is everybody stop panicking. We're not in a recession yet.
Then again, when I listened to Claudia Sahm on Yahoo Finance, Rick, I mean, it was, it wouldn't be too comforting if you were an equity investor. I mean, Sahm, well-known, well-respected economist, and she was saying the increase in the unemployment rate, the softening of the labor market, she used the word worrisome, and that, very concerned, she told us, that we could tip into a recession in the kind of near to intermediate term.
She also discounted her own rule, Josh. I mean, our host this morning asked her, are we in a recession? And she said, no, we are not in a recession. It's just that the economy is now it's not going in a good direction. But she also pointed out, look, the Federal Reserve has done absolutely nothing about this because it hasn't even started cutting rates. It's barely even started talking about cutting rates. But the Fed, as maligned as it might be for being so late to address inflation in the first place, still has some pretty potent tools. And it's obviously going to get started using those. I mean, look at how fast the narrative has changed here. I mean, literally like 4 days ago, we were still in the soft landing scenario. And just because instead of 175,000 jobs, we had about 60,000 less than that, just because of that, we're, in a labor force where there are something like 160 million people working now, we've gone from soft landing to hard landing. Feels a little bit overbought to me or overblown to me at this point. But we'll see what happens. This is supposed to be what the Fed was going to do, right? I mean, this is all bullish for inflation coming down. So the market is getting exactly what it wanted, which is a cooling labor market that's going to allow the Fed to start cutting rates, and everybody's hair is on fire all of a sudden.
All right, Rick, thank you so much for joining us. Have a great weekend.
Bye, guys.
It was a rough day for the broader markets, although we did close off the lows there. But the small caps underperformed. Russell 2000 off about 3.5% on the day. Joining us now is Nancy Pryl, Essex Investment Management co-CEO and senior portfolio manager. So Nancy, we were just having a conversation there with our colleague about this. Investors, they do seem to have new concerns about this economy, Nancy. I think a lot of people thought we were for sure just cooling here, but now maybe some concerns that actually maybe we're actually tipping into a downturn. How do you see it, Nancy?
Well, again, as your previous guest just said, the market does an excellent job of predicting recessions that don't occur. I believe the statistic is that the market has successfully predicted 13 of the last 7 recessions. That's about a 50% hit rate. We do see the economy slowing, and certainly there are a lot of indicators that show that it's slowing. But we don't say, one, we are clearly not in a recession today, and we really don't see the framework for a deep recession coming. We think it's likely that growth will go down to something below 1%, but we also think it's likely that we're going to see more rolling recessions like we've seen over the last couple of years. We're seeing some weakness in tech, but we're actually seeing some strength in industrials and some strength in healthcare that we hadn't seen before. We want the market to take a breath here, catch it, take a pause, catch its breath, and reevaluate based on the pretty good earnings that we've had coming out of particularly those industrial and healthcare sectors.
And Nancy, I know that you look at small caps in particular, and there has been a little bit of a rotation in small caps recently, but of course they fell more today than the broader market. So if things are slowing but not entering recession, and if the Fed is going to be cutting in September, what does that imply for small caps?
Well, that implies a very good stretch for small caps. A slowing but still positive economy is good for small caps. Lower interest rates are very good for small caps, particularly for those companies that do have floating rate debt that need to refinance their debt. Inflation coming down is very good news for small caps, and we're seeing all of those factors at work. In addition, some of the weakness that we're seeing in the large cap, particularly in the Mag 7 stocks, gives room for investors to look at the great growth stories that are emerging in the small cap space that they didn't need to look at before because they could get all the growth they wanted in those largest mega cap stocks.
Nancy, what does earnings growth look like for small caps? What are the forecasts?
So the forecasts are that earnings growth in small caps is accelerating. We've seen that so far. Now, we're pretty early in the reporting cycle. Small caps lag large caps by a couple of weeks, but we're starting to see that come through. And by year end, by the fourth quarter, we're expecting that the growth rate in small caps will be greater than that we've been seeing in large caps. And that is a necessary component to really have this small cap rally have legs, to see that growth rate not only accelerate, be positive, but also be greater than large caps.
Where within small caps would you be looking here? Because as some sort of skeptics of the small cap rally have noted, about a third of the companies in the Russell 2000 aren't profitable. So do you stay away from those in this environment?
Well, we think you need to differentiate between companies that might be cyclically unprofitable and those that are structurally unprofitable. So the cyclically unprofitable companies could be either growth cyclicals or industrial cyclicals that are coming out of a challenging environment, but where their business is improving and they're back on a path to improved profitability and better balance sheets. In addition, there are healthcare companies that are just not big enough yet to earn enough to cover their R&D and SG&A expenses, but as they can grow, they also will break into profitability. So we think you can look at those kinds of companies. We think you can look at those growth cyclicals. Again, we think there are a lot of opportunities in the lesser known areas of technology. What we would avoid in this environment are the concept stocks, those that have no revenue and are losing a lot of money, that are hyping a new technology where they haven't shipped those products yet.
Nancy, thanks a lot. Have a great weekend.
Thank you.
Some rare Friday after the bell earnings right now. Shares of AMC Entertainment higher by about 3.5% after posting second quarter revenue that was in line with analysts' estimates. Adjusted losses per share coming in lower than expected at 43 cents versus the 50-cent loss that was estimated here. So looking at the statement, Adam Aaron, the CEO, saying that the second quarter did start slowly because of the writer's strike in Hollywood affecting box office, but then he said it finished with a lot of strength. Inside Out 2, which he highlighted here.
Calls out Deadpool and Wolverine.
Yeah, but he's really drawing that contrast between earlier in the quarter and later in the quarter.
Yeah, he says it's as if we were two totally different companies, Julie.
Wow.
Surrounded by two completely different industry dynamics. Says in June, AMC achieved our highest ever June adjusted EBITDA in our company's entire history.
You know, he's been doing a lot of financial engineering in the meantime at the firm, as we know.
All right, time now for what to watch next week. Starting off on the earnings front, Palantir kicking off next week's calendar. The company announcing second quarter results after the close on Monday. Analysts saying Palantir's commercial segment may benefit from a Trump presidency.
And it's also a big week for media companies. Disney, Paramount, Warner Brothers Discovery, they're all on deck. And we'll also be getting a batch for earnings from the healthcare sector, including Eli Lilly and Novo Nordisk. Also, some food service companies like Restaurant Brands and Yum Brands, they're also reporting, giving us more insight into the state of the consumer.
And moving over to the Fed, we're going to be hearing from some Fed commentary on Thursday from Richmond Fed President Tom Barkin. This is coming after the FOMC left rates unchanged in July earlier this week. Fed Chair Jerome Powell saying a reduction in our policy rate could be on the table as soon as the next meeting in September. New question now emerging, could the first rate cut be a half point or a quarter point after that disappointing July jobs report?
Could it indeed? That's the question of the day. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow or Monday. Don't come tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It's official, bad news is bad news. A weaker than anticipated jobs report this morning, rattling markets. All three averages suffering steep losses. The Dow dropping more than 600 points in today's session. Now, rate cuts are all but certain at the next FOMC meeting, with some on the street predicting a half-point cut this September. And weak earnings also taking their toll. Amazon's revenue miss and weak forecast sent that stock tumbling in today's trade, but it could be worse. Just take a look at chipmaker Intel. That stock in free fall, down nearly 30% after missing profit expectations and suspending its dividend. The tech-heavy Nasdaq closed more than 2% lower after setting a record just last month. General market jitters also weighing on gold prices, the traditional haven under pressure as investors seek to offset other losses. But is the short-term drop an opportunity for folks looking to get in on bullion? Discussed with an industry insider. It's coming up later this hour. LVMH says no one's buying champagne. Lamb Weston cites softening demand for frozen potatoes. And Comcast is seeing a slowdown in its theme park business. So how much concern should there be about broadening consumer weakness? Joining us now is Scott Krisoloff, editor of the Transcript. Scott, it's good to see you. You know, obviously, you looked at the markets today, Scott. Investors have new questions about this economy. You know, I think a lot of people had bought into Jay Powell had kind of stuck this, you know, the soft landing, Scott, as rare and unusual as that is. And now, all of a sudden, investors seem to have questions about that. Maybe this economy is not cooling. Maybe it's turned cold. I'm interested, Scott, as you kind of read through the earnings reports, you read through those earnings transcripts. Was that a theme, a question you heard executives bring up?
I don't think that really executives were bringing up recession quite yet. I think that's a question that we'll see more next week. I think we've gotten a lot of negative high-level economic indicators this week between the employment report and also the ISM report earlier this week that have started to, impact people's confidence in the economy to the extent that now people are asking the question that you're asking: are we headed for a recession? But really, before that, what we had been seeing is broadening consumer softness, slowdown in growth. And so these were the precursors to things that we're seeing today. I think it just has spilled over into much higher level, larger question this week.
And broadly, when you look through those earnings calls, Scott, and they talked about consumer weakness, was it specific consumers they would highlight?
Well, for the past probably 18 months, almost 2 years, we had been seeing that lower income consumers were showing a lot more weakness than higher income consumers. And I think that's the big thing that we've noticed has been a change in the last couple of weeks, is that higher income consumers are starting to show weakness too. So you mentioned that champagne comment from LVMH. That was one that really stood out to me because it was talking about, a luxury purchase, something that higher income consumers might be purchasing, as well as the theme park comment from Comcast is one that I think was really important, showing that across the income spectrum, you may be seeing some consumer weakness.
All right, so some signs there, some broad consumer weakness, but you also, I thought was interesting, Scott, see some reasons for optimism, maybe a rebound in cyclicals you were highlighting?
Yeah, I mean, I think the reason for optimism is actually kind of a counterintuitive one. It's that underlying these trends of slowness that are starting to emerge in broadening consumer areas, you actually have had weakness within the economy for a much longer period of time, up to 8 quarters in areas like transports, in areas like capital markets, where capital markets have been more or less frozen IPO markets for a long time now. And those have all been symptomatic of higher interest rates. And so you've actually had this like quasi-recession going on underneath the hood of the economy, that as the Fed is starting to lower interest rates, that provides a springboard for more interest rate sensitive sectors to start to rebound. So we may actually be towards the bottom. Actually, a lot of the pain may have been taken in the economy on a more quiet basis, under the radar basis. And so as the Fed lowers interest rates, it may allow us to have a rebound.
And let's dig into one specific name, Scott, as well, Tesla. I know you had some thoughts on that one.
Yeah, I mean, I think Tesla, going back, I guess, to the consumer and this under the hood slowdown, I think the thing that has really prevented it from being a headline basis recession is that there's been AI has been a theme for the markets, as everybody knows, for the last 18 months or 2 years even. And I think that theme has been starting to slow a little bit as well, that the surprise in terms of how powerful large language models are is something that's not quite as shocking to investors today as it was a year and a half or 2 years ago. And so one of the things that we did notice in the Tesla earnings call that was really interesting, though, was Elon talking about the progress that they've made in full self-driving cars. And, his bullishness on that area with respect to AI is one that if they really solve the full self-driving car issue sometime within the next year or two, or however long it takes them to do it, the thing that really stood out to me in that call was how quickly they can deploy it and how much that could impact mass psychology for the markets, again, in terms of the AI wave, maybe seeing a renewal. So that's probably not something that's going to happen in the next 6 months, but it is something to keep on the horizon as something that could be another wave for this AI move.
Plenty of Tesla bulls coming on this show. Scott, and pound the table on AI and those robo-taxis. Thanks so much for joining us, Scott. Appreciate it as always.
Thank you.
Stocks selling off to end the trading week as the July jobs report shows more cooling in the labor market. Let's get to Yahoo Finance's Josh Schaefer with the trading day takeaways. Josh.
Yeah, Josh, so weak economic data continuing to weigh on markets. You just talked about that July jobs report, and that's what we're going to start with today. That really is what started our market sell-off, sent the Nasdaq into correction. And let's take a look at what we got this morning at 8:30. So what we're looking at here is just kind of the headlines from the jobs report. You can see the non-farm payrolls for the month came in at 114,000. To put that number in perspective for you, Josh, that was the second lowest monthly add we have seen in the U.S. economy since 2020. So that is a long time coming there to get that low of a number. And then to put this unemployment rate number, which came in at 4.3, higher than the estimate for 4.1, put that in perspective, that's the highest the unemployment rate's been in almost 3 years. That triggered a recession indicator, but we're going to wait a little bit to get to that. I want to just show you the market action that we got off of this. So you really had everything lower off of this. You can see NASDAQ down 2.4%, S&P down almost 2%. The Russell got crushed, and I want to highlight what we saw in yields over the last couple of days. So we're looking at the 10-year T-note here.
Wow.
Look at that.
Yeah.
Down almost, actually, I think it was more than, by the time we closed today, more than 40 basis points over the last 5 days. And kind of the key takeaway here being yields were falling because people were either concerned about the economy as a whole, concerned about economic growth. This is not because inflation is falling and the Fed is going to cut for good reasons. This is, oh no, the Fed might have to cut because there's weakness in the labor market. So kind of a different reason than yields have fallen in the last year, and that's why we saw red across the screen. Remember, over the last year, a lot of times when we've seen yields come down, we've seen green across the screen.
It's so interesting, Josh, too, and you've been talking about this, how bad news was greeted as good news for so long. Bad news meant a rate cut was coming. I mean, that was like a major storyline for like the first half of the year.
It was
and
a
now
major,
bad news is bad news.
It was basically a major storyline. I mean, we have the Russell 2000 here, so I'll pull it up for you, and we'll go 2 months here, and you'll see the run-up that we had in July. Josh, it was a storyline just as recently as 2 weeks ago, right? We had some economic slowing, and it was, okay, now the Fed's definitely going to cut in September. We feel good about that. And now we have quickly, very, very quickly moved on to, the Fed might actually need to cut more than we thought. And an area like the Russell 2000 is economic sensitive. The economy is supposed to be in an upturn. We're supposed to be seeing more economic growth for this sector to do well. And so that part of the trade has just largely kind of left us.
Big storyline shift. All right, what is the Josh Schaefer bullet board number 2? There it is.
Another recession indicator triggered, right? So we know, I guess our caveat here should be we've had a couple other ones trigger, like we'll say the inverted yield curve has been inverted for a long time now, and we haven't seen a recession, but today we had the SOM rule trigger. And so what economist Claudia Sahm was looking at here when she did this study for the Fed was the unemployment rate on a 3-month moving average versus the previous 12-month low. So this is a trend in unemployment. And if that gets above 0.5, as it did today when we got that 4.3, a recession has always come after it. That's dating back to at least the 1970s. This has been a very accurate recession
That's what I meant
indicator.
to ask you. If you're a viewer and you're listening, how reliable is this rule? What's the batting average?
Basically 100%.
That's pretty good. That's pretty good.
Now, the interesting takeaway here was Sahm herself was on our air this morning speaking on our show Catalyst, and she said she does not think we are in a recession right now. She thinks this heightens concern for a recession to come in 3 to 6 months. But given the pandemic, given the increase in immigration we've seen, which contributes to unemployment as more people come in, they need to find jobs and your unemployment rate will go up. There's kind of some special dynamics here. And she thinks the consumer has largely held up. So she kind of wants to see a little bit more data from the consumer standpoint before being fully concerned, saying recession is definitely coming. But our Madison Mills asked her to put it on a scale of 1 to 10, and she said it's closer to 10, but not quite a 10. So a little bit ominous there, Josh.
Yeah, for sure.
If I'm being honest.
I mean, she used words like concerned and worried.
Right. Not great.
All right. Thank you, Schaefer. Appreciate it. Coming up, gold set for weekly gains on hopes of rate cuts. We're going to speak to the CEO of Alamos Gold on the other side. More asking for a trend. Coming right up. It's been a solid year so far for gold, reaching another fresh record today. Investors look into the precious metal for safety amid economic concerns, rate cut hopes, and geopolitical risks. The moves higher in gold giving producers like Alamos a lift, the company reporting record production in the second quarter. And joining me now is Alamos CEO and President John McCluskey. John, it's good to see you. So you did report results this week, John. EPS and sales coming in above estimates. Your stock's up about 30% this year. It's up about 50% here over the past 12 months, John. I'm interested in the quarter, John. What drove the business? Walk us through it.
We're just having a great production across all of our assets. We have 3 producing mines right now, and our mine in Mexico, which we call Mulatos, it had one of the best quarters it's ever had. We have an operation in Ontario called Island Gold. We were mining one of the highest grade zones at that mine that we've ever mined. In fact, the stopes were reconciling positive. We were scheduled to mine around 12 grams, and we ended up mining around 14.4 grams. So we're getting better grade, higher production, and that's driving, record cash flow, low costs. We're getting effectively some of the best performance that we've ever seen, and that's obviously resonating with the market. Just about the time the gold price takes off, our production's taking off and our costs are going down. And I think what the market's looking for is that margin expansion, and that's exactly what we're delivering right now.
And just more broadly, John, just let's talk about the metal. I mean, the kind of strong run gold has had this year, John, just seeing these successive records. What is driving that, in your opinion?
Well, for most of the past year, it's been driven by central bank buying, and that's mostly out of Asia. And lately, though, I think it's a combination of things. I think it's a combination of political upheaval in the world. I mean, there's been an ongoing war in the Ukraine now. There is now added to that growing unrest in the Middle East. That's certainly been a contributing factor. But on top of that, we're getting into the later stages of the political the election cycle in the United States, and I believe they're talking more and more about the exponential growth of the U.S. debt. It's hit 35 trillion, and it's growing at a record pace. And I think this is starting to instill some real fear in the minds of investors, and ultimately that is turning their attention towards gold.
So this is the part where I ask you to take out your crystal ball, John. If you were to look ahead now, near intermediate term, where do you see gold prices headed?
I was asked that question about 2 years ago, and oddly enough, I settled on $2,400 an ounce 2 years ago. It was about $1,800. So it's from then till now, it's up just about 30%. Where it's going now, it's clearly in an uptrend. It's been in an uptrend really since it bottomed in 2016. Things turned around for gold in 2017, and it's been heading in an uptrend since. And it's a sawtooth pattern. It's very typical for gold, but in point of fact, gold is in a solid uptrend, and I think we're going to see levels like 2650 at least by the end of the year. That's where I think it's going.
John, so great to have you on the show today. Appreciate it. Have a great weekend.
All right, thank you.
Stick around. More Ask for a Trend on the other side. After jobs numbers came in weaker than expected in July, a metric called the SOM rule was triggered. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Man, we've been talking about this SOM rule, not just all day, but really for months leading up into this jobs report where it was actually triggered. So we wanted to give a little refresher. What exactly is the SOM rule? It was developed by economist Claudia Sahm, and basically it takes a look at the average of the unemployment rate over the past 3 months, and it's the difference between that and the lowest that 3-month average went over the previous year. If that rises a half a point or more, half percentage point or more, that could mean that we are in a recession. Now, Jay Powell earlier this week called it a statistical regularity. Some refer to it as an indicator. Doesn't mean for sure that we are entering a recession. Well, for that, we got the take of Claudia Sahm herself this morning on Yahoo Finance.
The SOM rule and many other indicators we've had of, say, recessions, like 2 quarters of GDP declines. We had that in 2022. We had no recession, right? Like, we really have to think about the particular context for now. So do I think we are in a recession right now? No. Do I think that the increases in the unemployment rate and the softening in the labor market is worrisome and we could end up in a recession in, say, 3 months, 6 months? Yes, I am very concerned about that.
And she's not the only one, obviously, judging from the market reaction today. So here's a look at the SOM indicator here, the recession threshold, this dotted line, and we've just gone above it. Obviously, we went above it when we had the recession during the pandemic time, financial crisis, et cetera. If you go all the way back to 1960 and then zoomed in on that, it shows us going above that level with that 4.3% unemployment rate that was reported today. So again, that recession indicator triggered. As to whether we're in a recession, we're going in a recession, Josh, obviously the debate is just beginning over that.
Yeah, and then it's also interesting to see the pressure on the Fed ramp as well, Julie, because of all this. I mean, how many economists and strategists were out today talking to their clients about how they were now banging the table? And some of them, to be fair, have been doing this for a while, that the Fed has just been behind the curve. And so putting up pressure what their next step is, the pace of cuts,
right,
when they cut.
Yeah, well, Mike Darda over at Roth MKM, he has been saying for a while that the economic indicators are pointing in the wrong direction. He thinks that we are currently in a recession.
Yeah, that was interesting.
But then we talked to Jason Draho over at UBS today. He thinks that the Fed should cut a half point, but he doesn't seem that concerned that we are in recession and thinks we could still see a soft landing. So it's interesting. There's a lot of dispersion both in where we are on the recession spectrum, but also in terms of what the Fed's going to do. But the Fed stuff seems to be coalescing more than the recession perception does. I'm realizing that even as I say it, Josh.
Yeah, bottom line, probably even more focused than usual now on Jackson Hole.
Yeah, most definitely.
All right, that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.